Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Reality radio for a really great future. We're talking real money.
Hey, thank you for being part of Talking Real Money. We are here every day to make your life easier when it comes to your finances. And we take all kinds of questions and calls, and this program is all about that. Roxy Butner, one of our advisors, regular contributor to Talking Real Money, will be joining us with those in just a moment, because a couple of people over the last couple of days again asked me, I don't want to own those stupid bonds because they ain't making me no money. And so I'm always like, let's go look. Well, okay, yeah, the last 5 years has been about a net -1 for the total bond market, BND, that is operated by Vanguard. So I decided to take a look at recent, like what about this year? Well, I think we're getting back to what we would call a more normal bond market, but we'll find out. But we'll know that in a few years. But BND, as I just mentioned, the return so far this year up 4.8. That's a total bond. And the yield at 4.2. DFIGX, which is the intermediate term government bond fund operated by Dimensional Funds, up 5.08. with a yield at 2.9, so quite a bit lower. Now, those are safer bonds. Remember, this is not a total bond there. That's just government. And then the Schwab short-term bond, SWSBX, up 4.3 with a yield of 4.0. But just fixed income just for a moment, because we all have a tendency to look at our portfolio and say, that made me a lot of money and that one made me nothing. So I think people have a tendency then to chase what's been hot or pick the one that's yielding more. And I want you to pick bonds for the right reasons. Keep those for liquidity and stability and against the shock of a stock market downturn, which could come any day. I didn't say every day. I started to say any day. And I don't want you chasing yield performance or management style. There's all kinds of people that are going to tell you they can make more bonds. I have yet to find those people. So I prefer you to own them for liquidity and stability. And I think in the long haul, if you go back about 100 years, you'd expect a total return of somewhere between 3 and 5%, which is not a lot when you consider stocks, but I think it'll make sense for you in the longer haul. Now, lots of questions have been pouring into talkingrealmoney.com, and click on Contact Us. You can type them in there. You can ask Don an audio question. Of course, you can call us Saturdays when we're live. Roxy Butner, who's very busy with her advisor practice, takes time to cull these a bit, figure out which ones she'd like to answer, and she's ask and answer. I'm going to give her both options today. I'll do some of the answering. She can do some of the answering as a practitioner. But what do we have in the proverbial money bag? Mailbag. We have something in the money bag too, but mailbag probably be more interesting to people.
Well, let's see here. So we've got our first question from Shelly in San Antonio, Texas. And she's asking a question about fixed asset allocation funds. She says, "Hi, Tom and Don. First, I wanted to take a moment to thank you all the time and wisdom you share on your daily podcast. I discovered your podcast about a year ago, binge listened to hundreds of episodes, and have truly learned a lot. One of the biggest takeaways for me has been the importance of rebalancing and keeping my investment strategy aligned with the right target percentages. I currently hold a few target date funds and appreciate the automatic rebalancing they provide. However, what I don't like is that they shift to a more conservative allocation as I get closer to retirement. Are there funds similar to target retirement funds that maintain a fixed allocation of U.S. and international stocks and bonds over time without adjusting to become more conservative, that also offer a low expense ratio? Thanks again for sharing your expertise and making complex investing concepts so much more approachable."
Yeah, that's a great question. And you're exactly right. The idea behind a target date fund is it matches up your need for return with the need for stability as you get into retirement. You want those monies not moving around as much. You're going to pull from them. And it does that for you. The whole idea is when you're young, you're going to be mostly in stocks. When you get a little older, you're going to be more in fixed income. So it is making that adjustment. If you wanted just a fixed one, Vanguard has a very fine, the Vanguard Balanced Index Fund, which is 60% in, I think it's just U.S. stocks and 40% in fixed income. I think that'd be a good alternative. But what's your take on this?
Yeah, they've got a few, actually. These are, sometimes you'll find them labeled as balanced funds, just like that Vanguard Balanced Fund that you mentioned. That one doesn't have any international, as you correctly pointed out. So that's one thing to consider. You're going to be missing out on international exposure with that. They have other ones. There's a Vanguard LifeStrategy Moderate Growth Fund. A little bit more expensive, 0.13%, but it does have some international and a little bit more small because it's got some of that international small as well. So I think it's a good point. A lot of folks, they get into target date funds really young, and then they might be more conservative than they intended to be, 15, 20 years down the road. So it can be difficult to kind of have some flexibility with your funds or with tax efficiency if you have everything just in one fund, but like in an IRA, that could work really well.
Yeah, and target date funds, again, if you want to spend no time on this and you have no knowledge about this, I think they're a good alternative. Got to make sure you own the right ones because some are high expense ratio. What we're looking for is index style. Number two, the criticisms I've had in the past are they're telling you what your risk tolerance is because you may have a completely different feeling about risk than somebody else who's of the same age, but they're telling you, here's what your asset allocation is going to be. And my other sort of mild criticism is they tend to be more in U.S. stocks and more in large stocks. We'd prefer to see you balanced across the globe and have a tilt, if you will, to smaller and value stocks, which have had a better long-term return. But in a general sense, for many of you, don't want to mess around with this, they're a pretty good alternative.
Yeah.
We got more. I know we've been getting a ton of questions to talkingrealmoney.com. So keep them coming. We love it. Yeah. Plus, we get to have Roxy on when you do that.
So we've got another question. This is from Frank in Philadelphia, Pennsylvania. And this is on that note regarding U.S. international split. And they say, hey, Tom and Don, my question is about a proper U.S. and international split. I prefer to have anywhere from 40 to 50% of my portfolio in international, but I also have a preference for simplicity in case one day, hopefully not for a long time since I'm only 38, something happens to me and it's easier for my wife to figure the portfolio out. I prefer dimensional and Avantis funds, but I don't like that AVGE and DFAW are heavy on the U.S. side. I also do not like VT because I want to tilt away from market cap and towards small and value. Would going with AVGE or DFAW really make that much of a difference than if there was a fund out there that was a 50-50 U.S. and international split? Am I overthinking the additional 10-20% of my international preference? Love the show. Thank you for all the advice and wisdom.
The short answer, Frank, is yes, you are overthinking this. But let's just pull this apart a little bit, parse it, if you will, because you say you prefer to have 40 to 50% of your portfolio in international. If you look at AVGE and DFAW, I believe they're both about 70% U.S., 30% international. So they're not that far off of the number you have. When you make and Don, I know he still believes in 50-50. If you go back about 20 years, that's about what it was. Half of the value of stocks was inside the U.S., half was outside. Much of this change has come as a result of strength in the U.S. dollar, which has been down, as you may know, this year. So that's changed, and international has done much better. Yeah, this is an area of continuing debate. I trust the academics at both Avantis and at Dimensional that tell you really just put the money where the value of stocks are today. We don't know how that can change over time. And so I think you're going to be fine with either one of those one funds, especially in light of what you mentioned, Frank, and that is you have a greater interest in this than your spouse. My wife, for example, is just going to make a phone call. She doesn't want to think about it, just wants to know the money's going to be there. And while she should know more, and she's listened to me speak many times and was probably following on something on Instagram while I was talking, the reality is, yeah, I think one fund in both of these cases probably makes sense in your situation. But what's your take?
Yeah, I totally agree. I do think you're overthinking it. Strategy, keep it simple, track the global market as it is. And as Tom mentioned, it has changed and it will change. So I think it's more about who do you want to choose to implement that strategy for you. We trust that Dimensional Fund Advisors and Avantis, they do keep track of the academics and the research, and they will adjust the split between U.S. international depending on what happens in the global market.
Yeah, I think it's going to be an interesting year for all that, because we may get to the end of the year and find out that the split is closer to 60-40. I think right now it's about 65% of the value is in U.S. stocks, 35% in international. When some of these reevaluations take place in the fall of this year after international's done so well, I think international small cap value is up over 30% year to date. We may see a change there, but we'll see.
Yeah. And I will say one more thing. You asked how will this affect your returns kind of over the long run. There's no way to tell, is international going to be up for the next 30 years? Is U.S. going to be up for the next 30 years? So your best bet is to kind of track the market as it is.
I think that's exactly right. And there are decades. We had a great lecture from, I think it was somebody from Dimensional Funds that talked about decades going back to, I think, the 50s or 60s. You generally have these decades where the U.S. is dominant one decade, international is dominant the next one. We could be heading into a time when international is, because the U.S. has been, frankly, the leader since the financial crisis of 08-09. Who knows what's next? But make sure plenty of your money's there. And I think in your case, because simplicity makes sense, and especially if somebody else has to take care of the money after you, good solution to make a one-funder there.
So our next question is from Angie in St. Paul, Minnesota, and I have some of the nicest clients out in St. Paul, Minnesota, so I have to shout out that area.
I got to shout out all the people in the upper Midwest that listen to us, that respond to us. Some of you know we came there last summer. We had a ball in Wisconsin. We are coming back. I don't know when, but we're going to do it. I loved it there. And so thank you all for joining us on the podcast.
So Angie asks about institutional shares. She says, I noticed a CL at the end of many of the funds my advisor from Ameriprise has me invested in for my Roth. I asked him what this meant and was told these are institutional shares, which means they are only offered to investment firms and they are at a much lower rate than I could get on my own. My advisor is a fiduciary, rebalances things frequently, etc. Wondering, is there a downside to these kind of shares? They have done fairly well, but they do have expense ratios that are higher than what I invest in my taxable Schwab account, and they range from 0.49% to 1.11%. Should this concern me?
Yes, it should. C shares, of course, are add to the regular expense ratio, right? This alphabet soup, A shares being a front-end load, B shares being a back-end, all this nonsense. But so CL. Now, what did you find on CL? Because when you say C to me, I think that's the one where they just add to the expense ratio. And then when you tell me they're 0.5% to 1.1, which is considerably higher than we'd like to see. But what's your take on this?
Yeah, I think, there could be two things going on here. So CL, it's not a standard share class. It could be something maybe proprietary to Ameriprise to identify them as maybe institutional or who knows. Or it could be a variation of the C class shares, as Tom mentioned.
But these are still too expensive. Again, now some of this comes back to, for example, Angie, how are you paying this person that is you call a fiduciary? If they're taking commissions, I really wonder if they're a full-time fiduciary, because they shouldn't be. But how are you paying them? Because if they're taking these large expense ratios and you're also paying them, let's for sake of argument, 1% on top of it, now you're really paying a lot of money to somebody to build that portfolio for you. I think that's on the high side. I'd be looking at that very carefully, maybe even getting a second opinion to figure out if you're being treated fairly.
Yeah, absolutely. I will say, too, with your question, should this concern me? I think generally speaking, you can probably get the same exposure with much lower cost funds. So why wouldn't you look into that? So I think getting a second opinion is a great idea.
Yeah, I like what you just said. The same exposure with much lower funds. Now, remember, we're no smarter than anybody else out there, but the funds that we use through people like Avantis and Dimensional, iShares, I think on average, our portfolio is like 0.17. So it's far, far cheaper than something that when you say 1.11, for example, or even 0.5%. Remember, ours would be about a third of that. So, and you should find somebody who's doing it that way. The odds are going to be on your side in terms of return because those funds are less expensive.
Yeah, and it sounds like you already have a separate account at Schwab. So, I mean, any advisor you're working with should be looking at your picture holistically. So I'd hope that, somebody's taking a look at your entire portfolio altogether.
Hey, anything more in can we call it the money bag? No, the mailbag. The mailbag. They keep coming in, talkingrealmoney.com. Click on Contact Us. We'll be glad to answer. By the way, if you want to talk to Roxy, you can go to talkingrealmoney.com. I know you're busy, but of course people can reach you there as well. Ask an advisor, meet an advisor. I always say ask an advisor, meet an advisor, and you can do that as well. But what else we got? This is it, right? I think I see the last one in your hot hands there. Yeah, go.
This is from Ford in Houston, Texas, and this is about long-term care annuity products. Hello, Dawn and Tom. My wife and I appreciate your podcast. We're both 62 and have a retirement portfolio of about $700,000, which is behind where we should be for various reasons. We're debt-free and are stacking it away and should be at $1 million by 67 and may work until 70 for additional cushion. Our home is paid for and worth $300,000. I have a history of dementia and some health issues, although we are both relatively healthy for our age and we eat healthy and stay active. We want to get some kind of long-term care protection. Traditional insurance would be $6,000 to $10,000 per year, and we would have to pay that for the rest of our life. We've been presented an annuity option with a long-term care rider. Basically, it is being sold as a portion of your portfolio as a fixed income fund where you pay in a lump sum and the benefit payout is 3 times that amount. So we put let's say we put $100,000 now, and if we need coverage, we would have access to up to $300,000 in benefits with some limits on monthly payout. What seems attractive is that if we do not have to use it, the funds grow at a slow rate, but our beneficiaries would get what's left. Without going into too much details here, we would like your thoughts on this. We've heard you talk about annuities many times, so we are aware you are not fans. Most importantly, what would be your recommendation to get some long-term care insurance? We realize we may have to pay out of pocket some. Most insurance have a waiting period where you pay out of pocket anyway, and for this product, it is 90 days. We feel that $300,000 benefit is solid enough for most bad situations. We want the peace of mind and do not want to burden our adult children.
Yeah, so this is a hybrid policy. Most of the policies sold now in long-term care insurance are this. You give them a hunk of money. They are going to insure you. They have that money. And as you said, if you don't spend it, you get some of that back at the end of your life, or the end of your life. You're not going to need it a whole lot at the end of your life, but the others in your life could get it. So that works. Here's my challenge for you in this situation. Depending on how much you gave them, that could really interrupt your potential cash flow in retirement. So I would first run that and say, okay, I'm retiring at this age. I need this much income. Here's my portfolio. How's that going to provide it? And I'd get some sort of Monte Carlo examination of that and see if it's going to last for the next 30 odd whatever years. I would do that first. Then I might say, okay, now with that in mind, do I have money out of my portfolio that I could peel off and buy the hybrid policy? You are a bit between a rock and a hard place here. I will say that most of the time, I've read a lot about this, long-term care turns out to be short-term care. You know this better from a family situation than I do. But so people have a tendency that believe in insurance to over-insure and then not need it. Not telling you not to have the insurance. Don probably would because he's not a believer in insurance. I do believe in insurance. I do not have long-term care insurance. I have more assets than this, so I think I'm okay. But I would do it the other way around. I would run the plan first to see if it works. If it did work, then I would go ahead and then feel if I could peel off any of that money. But this is always a tough question. It comes up a lot, and the answers are never very easy to come by. What's your take as an advisor?
Well, and I see this situation on the opposite end. Once folks are getting into their older age, they've had this policy for 20, 30 years, and they're like, what is this? What do we do with it? And recently I had a case with one of my 88-year-old clients and her family. We spent hours on the phone with the reps from this insurance company because she does have a policy which does have a long-term care rider. And what it does is it'll double her benefit for up to 5 years if she has an assistance need with more than 3 activities of daily living.
To how much, though? How much? I mean, double it. The number to me seems to be how much she's going to get a month. In this case, how much was it? Do you remember?
Yeah, it was like $1,200 originally, and then,
now it's 36.
Well, it'll be like 24. It's only 2 times. It doubles it.
See, now, I don't know what, I mean, again, you know this more than I do, but I mean, here in the Puget Sound region, I mean, my mother-in-law just passed away this year, and I think she was spending something like $7,000 a month. It's not cheap. Now, depending on where you live, that can be far different, or the type of care you're getting. That's the thing I would be looking into.
So she's down in Florida. So a lot of these, you want to know, the only thing I'd advise is you really want to know back to front the policy and exactly what the terms are, especially when you get to the point of needing to use it.
Okay, but stopping you there. If you ask the people selling this policy, you may not get an accurate reflection. That's where you may need to get some other outside help, I think, correct?
Yeah, I mean, like I said, we spent hours on the phone, some reps more knowledgeable than others. So it is difficult. But if you get someone who at least understands the verbiage to maybe be on the call with you, you can probably get better answers. Ultimately, what we decided in her case was to do a side-by-side analysis and assume she lives to 100 and see at age 95 if she had a health event, would it make sense from a monetary perspective? And actually, it would if she was able to use up the full 5 years because her age, she's already paid into it so much. But interestingly enough, her and her family decided they want to surrender it because of how complicated and difficult it is to get any help from the folks at this company.
Because of the attitude of the insurance company. That's what I'm hearing here. Yes. That they weren't very forthcoming. They weren't very helpful. Interesting.
Yeah.
Okay.
So this is... And also because oftentimes, even though whatever account values left would go to her beneficiaries, they have fees and other things that really draw down the account value. So there probably wouldn't be very much left for the beneficiaries. So ultimately, she had some other assets that she could care for herself if she needed. And that was the choice they made. So all I want to say is know the terms of the long-term care rider.
So you're going to have to dive into it. It's not going to be as simple as the 1, 2, 3 kind of thing. Yeah.
And whatever they're telling you to get you into it, just ask a lot of clarifying questions and don't take everything at face value.
And how about, in this particular case for Ford, do you think, running the retirement income number first, then going back and saying, I'd like to afford this insurance. Do you feel like that's a good approach?
Yeah, absolutely. I would, like you're saying, take out the $100,000 and see if that works. And so if you can afford to basically take the $100,000 coverage, yeah, I absolutely love that approach.
And by the way, in my situation, if I reach age 90, my family's already been ordered to surrender me to the middle of the lake I live on. So we'll see what happens. But I may flail for a while, but the water, it's warm.
It's a small lake.
So it's a small lake. It's only 30 feet deep at its deepest, so
it's beautiful.
Recoverable. Thank you for that. All right. If you've got questions, if you want help, if you want to take the risk quiz, all of those things, guess what? They're all available online. TalkingRealMoney.com, TalkingRealMoney.com. We're there to help you. I want to say thank you to Roxy. She has an extremely busy practice, takes the time to not only peel these questions off all the ones we're getting, but then take the time to be thoughtful about this and supply real life examples. So that's very helpful.
Yeah, no, it's good. It's really fun. We've been demoted to a smaller little studio here, but we've got bigger windows.
I wonder what the next stop looks like when I got in. I'm like, that's going to be bad from here. So take advantage of all the stuff that we're here designing to help you every single day, because no matter what day of the week it is, no matter where you are, we will be right here talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.